I was telling somebody at dinner last night that, you know, when you sit in London or in Toronto or in New York, you think that you are sitting in the center of the universe. And then you come visit a place like Shanghai, and all of a sudden you're not so certain about where the center of the universe is. And it's obviously not just Shanghai, but the global footprint. The footprint that China is having on every corner of the globe and in every domain of life is remarkable. And you have a great deal to be proud of. So I was asked to come and talk to you about the state of affairs in North American hedge funds, Canadian hedge funds, and to give you a sense of where we see risks and opportunities today. I'm happy to do that, but right before I got on the plane, just before I share my thoughts with you, I also realized, before getting on the plane here, that how the Chinese define hedge funds and how North Americans define hedge funds is actually quite different. So I thought, for the benefit of this discussion, I'd give you a quick definition of how we see hedge funds and give you a little bit of a story, a history about its evolution. So we define hedge funds, as you can see right here, as limited partnerships that are allowed to take on leverage. They employ a broad range of investment vehicles, such as derivatives and options. They engage in short selling, and all of this is for the purpose of achieving either more stable or superior returns. And when you layer on top of that incentive fees or compensation that's a percentage of profits, that is your prototypical North American hedge fund. So where did it come from? The very first hedge fund was formed in 1920. It was formed by Warren Buffett's primary mentor, a fellow by the name of Benjamin Graham, and his partner, Jerry Newman. And at that time, they set up a limited partnership where they took a percentage of the profits and took both long and short positions. The problem was that in the 1920s, the word hedge fund didn't exist. So as a consequence, the creator of the modern day hedge fund is a gentleman by the name of Alfred Winslow Jones. Alfred Winslow Jones, he was a journalist for Fortune magazine, and in 1949 he left Fortune magazine to start his own asset management company called A.W. Jones and Company. And there he developed a strategy where he attempted to perfectly hedge out market risk by going long and short in equal measure. And unlike his predecessor, Jones also employed the use of leverage in short selling, which regulated investment companies at the time could not do. And he added a management fee, creating the modern 2-in-20 compensation scheme that most or many hedge funds use till this very day. The reason that he's credited with being the founding father of the hedge fund industry, and certainly in North America, is because in 1966, a woman by the name of Carol Loomis, who's also a journalist for Fortune magazine, wrote about Jones' success after his fund outperformed the next best fund in the world by 44% that year. She wrote about his success, and in that 1966 article, she coined the word hedge fund. Immediately after that article came out, between 1966 and 1968, there were roughly 140 new hedge funds that sprung up in the United States, all of them trying to imitate the success and replicate the success of Alfred Jones. The problem is they didn't understand how difficult shorting actually is, and particularly because 1967 and 1968 were rising markets in U.S. equity markets. So most of these funds blew up, and the few that survived, they became effectively long-only leveraged vehicles. The 1970s brought about a whole new series of challenges. We had the Vietnam War, we had the energy crisis, we had Bretton Woods, which is where effectively the abandonment of Bretton Woods, which untethered the dollar, separated the dollar from the gold standard, and all of that sent equity markets collapsing. And so by the mid-1970s, the hedge fund industry was practically dead, non-existent. The 1980s proved to be a resurgence for the industry, and that's where many of today's legends, individuals like George Soros and Steinhardt and Robertson and Paul Tudor Jones, etc., that's when they first appeared on the scene. In the 90s, there was a new wave of hedge funds, which were virtually overnight success stories. Until, of course, we hit the late 90s, and there we saw the collapse of long-term capital management, which was one of the largest hedge funds in the world, the largest blow-up in the world. We had the Russian debt crisis, and of course, we had the dot-com bubble. Shortly after the dot-com bubble, we saw an even greater resurgence of hedge funds, with dozens upon dozens of American hedge funds being launched each and every week. And even the crisis, while things slowed down in the crisis of 2008, as a result of very drastic regulatory measures that were introduced, such as Dodd-Frank, which forced the banks, who were themselves utilizing many hedge fund strategies, to close all of their proprietary trading desks. And what this did was it flushed thousands, if not hundreds of thousands of talented traders into the marketplace, each of them looking to effectively launch or join a hedge fund of their own. And that explosion of hedge funds has continued to this very day, and not just in the United States, but all over the world, and it's nice to see that it's happening here in China as well. And that creates many challenges and many opportunities. So where does that bring us today? Today, there are at least 18,200 of this North American type hedge funds that I described. They control over $3.2 trillion in assets, and they receive the most attention from Wall Street, primarily because they pay the most for research and they have the highest transaction costs on the street. They are also involved in some of the highest profile transactions. The other thing hedge funds do is attract the the greatest talent on Wall Street. And the reason that you do that is because they're involved in some of the most innovative works and the most innovative pioneering strategies, but more importantly, because they make more money than everybody else. Just to give you an idea of how much money are made by U.S. hedge funds, if you took the top 25 hedge funds, if you take the top 25, those hedge fund managers, the top 25, make four times the amount of all the salaries of all the Fortune 500 CEOs put together. So they're able to recruit some good people. While all that sounds great, the hedge fund industry in North America does not sound terribly happy today. Because if you look at this graph, what this graph shows is that over the last 5 to 10 years, the majority of hedge funds and the majority of active managers in general have underperformed all active indices, whether it's the S&P 500, the S&P China, and the CI World Index, pretty much all of them. Broad range underperformance. And while the Canadian hedge funds haven't exceeded the benchmarks, they've done slightly better. And there's very simple reasons why our hedge funds have done better. They're smaller. That's it. Over 50% of Canadian hedge funds have less than $100 million under management, which means that they're better able to respond to opportunities, they're a little bit more nimble, and they're able to capture mispricings in the market, small mispricings where the large funds are unable to take advantage of. Even with this unimpressive track record in the sector, I suspect that Canada's hedge fund industry will continue to grow. And it will grow because it occupies a disproportionately small percentage of capital markets in Canada, much like I suspect it does in China. And therefore, the gross underperformance over the last number of years has not really hurt the majority of investors like it did in the US. And you see, like magazine covers like this one here haven't appeared in Canada. This is largely an American frustration. The other thing is, because Canadian funds are smaller, there's less competition, they're less likely to be arbitraged out of trades. They're accustomed to paying higher fees. For a number of reasons, Canadians pay some of the highest fees in the world. Fees have been a major frustration of hedge funds, but Canadians have been accustomed to it. The other thing is we have an influx of talent. So due to the strength of our financial sector, there is a seemingly endless supply of traders and capital allocators coming off the proprietary trading desks at the banks. And lastly, the regulatory environment. Ours is quickly becoming one of the most transparent in the world. So now let me tell you, after just sharing all of that, let me tell you why the Canadian hedge fund industry is largely irrelevant. If our respective hedge fund industries were planets, here's approximately what they might look like. That big one on the edge, that's of course the US. The UK, it's actually a little more flattering, it should be a little bit smaller. Here we have China. And that little speck, that little dot in the bottom, which I don't think anybody here sees, that's Canada. And the reason being is because in Canada, we don't have any hedge funds that are larger than $3 billion. Whereas in the US, there's over 30 hedge funds that are larger than $20 billion. And that's just hedge funds, not private equity, not a whole slew of other funds that are colossal. In fact, our entire hedge fund industry is only $35 billion in a few hundred funds. If you think about that, to put that in context, there's at least 10 funds in the US and Europe that are larger than Canada's entire hedge fund industry put together. Groups like Bridgewater and Man Group and AQR, etc. And why is our hedge fund industry so small? Well, because our population is small. You could fit every man, woman, and child in Canada into Shanghai and still have room for most of the people here. And the larger investors, groups like ourselves, pension plans, insurance companies, other institutional investors, tend to invest outside of Canada. It's important to note that while the Canadian market is small, it is also quite powerful. Canadians have exceptional access to global markets, virtually all global markets, with extremely sophisticated institutions and investors. We have one of the strongest banking systems in the world and very robust capital markets. For example, the Toronto Stock Exchange is listed as one of the top global markets and has more new listings each year than any other global exchange. We have strong regulatory framework, superior cost of professional services. You could get the same services in Canada as you could in the US for at least 18 to 20% cheaper without compromising on one iota of quality or sophistication. most vibrant flows of deals and opportunities and transactions, and probably why we have more lawyers and investment bankers than anybody could need. So, now that I've given you a little bit of background on Canadian funds, I'd like to share with you my view as an investor across all asset classes, where I see some of the risks and perhaps some of the opportunities today. So we basically have, all of us have 7 asset classes at our disposal. We have cash, we have fixed income, equities, uncorrelated or hedge strategies, we have private equity, real assets or real estate, and we have credit. That's it. So let's look where we are. So cash, when we look at cash, rates are still low, doesn't pay you enough, still punishing savers, so hard to keep money in cash. We have fixed income. With rising rates, bond prices falling is an inevitability, so allocating money to fixed income and bonds is a difficult undertaking. Equities. Equities today, at least in North America and in Europe, are at all-time highs. And there are structural trends, such as indexation, which we'll talk about in a minute, which make the markets very complicated. So equities need to be approached with extreme caution. Uncorrelated or various hedge strategies. Well, we saw that hedge funds haven't been able to navigate the markets effectively over the last 5 to 10 years. And that's, again, largely because of increased competition, crowded trades, etc. So, not a lot of confidence there either. We have private equity. Private equity today has valuations almost as high as public equities. Very difficult to source opportunities. And I know that because a lot of the private equity funds I'm invested in have not called committed capital. They themselves are struggling to find the deals, the opportunities. Real assets and real estate, much like equities, it's at all-time highs. And because in this lower interest rate environment, people are treating income-producing properties like a fixed income alternative. And the problem with that is the valuations are crazy, and they don't sufficiently reflect the risk that's being undertaken. And just, I guess, in Canada, for example, the Chinese have single-handedly increased Canadian real estate prices by 200%. And I mean, I don't know why Chinese have focused predominantly or primarily on real estate. There are many more other compelling opportunities, but that's what it has been. And credit. Distressed debt has virtually disappeared. And perhaps the greatest issue with credit today is that liquidity has become a bigger issue in North America than it has been in about 40 years. So, in China, you have, and to my understanding, you have liquidity challenges because of limitations on what investors can do. In other words, limits on trading, on derivatives, on securities lending, etc. But in North America, we now have liquidity challenges because of what the banks can do. So in the aftermath of 2008, while central bankers were encouraging lending through various quantitative easing programs, the regulators, in their attempt to cut down the risks, were simultaneously cutting back lending activities by the banks. So what happened is that bond inventories have virtually evaporated. Today, if you have $1 billion of bonds to sell, there is no dealer that will take your order. You have to have a buyer that's willing to buy $1 billion worth of bonds that very minute, or else there's no bid. So what we have is a very significant decrease in leverage in the private sector with financial institutions, and simultaneously an increase, a very significant increase in leverage in the public sector with governments and central bankers. So essentially there's more debt and less liquidity. And it may take many years and perhaps even a crisis or two for the system to adjust to this new dynamic. One of the biggest trends we've seen in capital markets today is indexation. And what you see here is passive strategies, ETFs, indices, taking significant market share from active managers. And generally this is a good thing because it reduces the cost of investing. But people don't understand the ramifications of this. With the rise of indexation, it also means that there's much less fundamental analysis being done. And many investors today, they don't own Exxon or Apple or IBM because they believe in it, because they want to own it. They own those securities because they have to own the index. So investments are made for structural reasons, not financial reasons. And that reality can significantly distort prices, particularly when you have a security that comes into an index or when a security comes out of an index. So securities now trade because of asset allocation decisions, not because of security selection decisions. And that makes the market much less efficient. And since so many stocks are being bought, sold simultaneously at the same time, it also significantly increases correlations. More and more markets are moving as one. Because if a pension plan or a sovereign wealth fund needs to lower their allocation to equities, they'll be selling off Apple and Exxon and IBM altogether. And what this also means is this translates into increased volatility in the market as a whole. We do not yet know the full extent and all the ramifications of indexation. But one thing is clear, and that's the fact that markets more and more are starting to move in tandem with one another, which is what this chart here shows. The other challenge that we face is competition. In every sector, whether it's consumer goods, whether it's manufacturing, whether it's technology, the more competition there is, the better it is for the consumer. The only exception to that rule is asset management. In asset management, the more competition there is, the more efficient the market becomes, and the more efficient the market becomes, the lower the returns for the investor. So increased competition, whether it's in China, in the UK, in the US, in Singapore, affects every single person in this room adversely. And of course, if those challenges weren't enough, there also doesn't seem to be any growth. Historically, global growth has averaged above 4%. And we are nowhere near that today. And even in developing or emerging markets, for there to be 4.8, that's actually quite low. So investors and money managers, unfortunately, have a tough road ahead, as there is no significant growth in sight, and it's hard to see what justifies the rich valuations that we're seeing in various markets today. And the irony is that while we have all of these challenges, and investment managers have to work harder than ever to generate decent returns, they will also have to do it for less money, because investors are driving down the cost of asset management more and more each day. So today, what are we left with? We have the most highly valued market with low liquidity, high degree of correlation, lots of competition, global growth is nowhere to be seen, and the managers who have to navigate, the asset managers who have to navigate this landscape are being told that you have to work harder for less. When we put it all together, it appears that this may be quite possibly the most difficult time to be an investor. So what do we do? What do we as investors and fiduciaries do? To answer that question, let me give you a little bit of background as to what I'm busy with when I'm not visiting Shanghai. So for most of my waking hours, I have the honor of being the partner and senior managing director of Prime Quadrant. That's where we hang out in Toronto. And at Prime Quadrant, we help some of Canada's wealthiest and Europe's wealthiest families make better investment decisions. And our two primary functions there are investment research and investment consulting. On the research side, we're helping them identify best-in-class managers, investment managers, and opportunities worldwide. And on the consulting side, we're helping them, we're educating them and helping them make the best decisions that they can to give them the highest probability of meeting their personal goals. I tell you that because one of the things that we're constantly reminding our families is that while many market cycles require us to pause and be cautious, it is also true that there are always pockets of opportunity for those that aren't swept up by the emotions and sentiments of the market. And here are just a few examples from some of the things that we touched on. So we talked about structural concerns and the unintended consequences of indexation. Well, there are also strategies that take advantage of that. Strategies like index arbitrage, where hedge fund managers are trying to figure out which stocks are coming into the index and which stocks are coming out of the index. And if you know that information, you know that the company that's coming into the index will have a fairly quick run-up in price and trading volume, whereas the stock that's coming out of the index will have a collapse in price and trading volume. So if you short the one that's coming out and go long the one that's coming in, hopefully make money on both. Cyclical concerns. If you think that the markets are fully valued and that it's ripe for a correction, particularly in North America, it's worthwhile to revisit CTAs, which some people have spoken here about, and managed futures. I mean, particularly with the managers that I'm invested with, who do extremely well when markets collapse. They may have benign returns in rising markets, but it's like having an insurance policy that pays you a premium instead of the other way around. We have systematic concerns. We talked about the absence of liquidity. Well, if traditional liquidity are exiting the markets, then it's fairly obvious that those who can become a liquidity provider will be richly rewarded. And even simple strategies like buying secondary private equity funds. Effectively, these are limited partnerships units, illiquid units, that for those who are desperately in need of liquidity will be able to pick them up at steep discounts and profit handsomely through that transaction. We talked about economic concerns. and it's the prospect of low growth. And this, again, there are always pockets of geographic opportunity, and just by looking at this map, you can't really see what's made out here, but I can tell you that it's going to be a lot easier to make money in China, India, Mexico, than it is in Germany or Australia and Russia. And that brings me to the last topic of conversation, which was touched on by the last speaker, the China-Canada collaboration. And I think the other speaker eloquently put it there, there are going to be countless opportunities for collaboration between Chinese and Canadian investment managers and investors. For starters, there's a shared wisdom, which is leveraging each other's resources and expertise as we enter new markets and cycles. There's educating about the nuances. Anyone who ever enters a new country or a new market has a very difficult time segmenting the various cultural nuances, hiring quality personnel, and even adjusting to the nuances of systems, regulations, and institutions. And then there's adjusting to size. China has experienced one of the most rapid and remarkable modernizations in history. And that is fantastic, but it has also seems to have made it difficult for the regulatory regime to keep up with it. And it seems that Chinese have more capital than high conviction and highly compelling opportunities locally to deploy that capital. Conversely, in Canada, we have a regime, a regulatory regime that's far too sophisticated for the small market that it serves. And there are far more opportunities, compelling opportunities that are too big for our small market to handle. So both can benefit from one another. And in reality, there are countless ways to collaborate. But misconceived notions, misunderstandings, and sensational news stories often get in the way of that. So communication is critically important. Another thing that's important is the recognition that we are afraid, all people under the sun are afraid of the unfamiliar. And that is true both psychologically and physiologically. As Dr. Peter Kenning, a professor at Germany's University of Munster, he demonstrated that the mere thought of putting money in foreign stocks and foreign securities actually generates an automatic sense of discomfort and sends signals of fear throughout the body. Not only are we afraid of the unfamiliar, but we tend to think and believe that the unfamiliar is actually riskier. You know, for example, Europeans have no hesitation to go out into the forest and collect mushrooms that they'll cook up for dinner. Maybe that's fine here too, but in America, people think that's wildly dangerous and reckless and risky. At the same time, most countries in the world think it's insane that in America there are more guns and rifles than US citizens. Both may be right, but I don't know if one is more right than the other. The thing to remember is that fear is not rational, and it doesn't necessarily correlate with risk. In North America, we have many people who are afraid to fly, but have no hesitation about getting into a car. And when we look at the numbers, in the US alone, there are 35,000 people that die in motor accidents every year in America. 35,000 people a year. But when you look back over the last 20 years, there haven't been died in flight crashes. And that's even after you factor in, even if you factor in the 256 people, passengers who perished in the 9/11 terrorist attacks. But people are petrified of planes, so risk and fear is not necessarily correlated. So how do we reduce the fear of collaboration? So besides overcoming any linguistic and cultural differences, how do we increase mutual trust? And I think the ideas, the suggestions are very basic, they're obvious, but it's worth repeating. Each side needs to invest time, money, resources in developing deeper local relationships by identifying trusted partners on the ground. There has to be an increased role of the diaspora. In other words, those Chinese that are living in North America, those North Americans that are living in China, they could be phenomenal bridges for one another. And another step forward would be increasing the involvement of China's private investors. Historically, some of the largest investors in Canada have been Chinese state-owned enterprises. And while that has generally been welcome, it has been also met with some political suspicion. But in the last 5 years or so, there's been this shift and towards more private sector, private investors coming into Canada, and it's a positive step forward because it increases trust, increases the diversity of investors, and provides multifaceted cooperation. And lastly, it's creating educational forums like these. I am absolutely humbled by your invitation. And I realize that I may be the most difficult presentation for everybody here to understand throughout the day. But it speaks volumes of the thoughtfulness and the consideration of the organizers of this event, who were kind enough and thoughtful and open-minded enough to invite me to join you, to invite an English speaker to join you for your conference. The most difficult thing about all of this is that it takes time. And perhaps the greatest analogy that I could share to conclude my remarks is the growth pattern of the Chinese bamboo plant. Unlike almost any other tree in the world, Chinese bamboo plant is planted, it's watered, it's nurtured for an entire season. And yet, after all this care, nothing but a little shoot, small, tiny, emerges from the ground. The next season, once again, the farmer comes out and he waters and he provides fertilizer and he cares for this little plant. And again, at the end of the season, nothing but a little shoot emerges from the ground. And he repeats this seemingly useless exercise in the third year. And nothing but a little shoot comes out. By the fourth year, his friends and his family, they're all making fun of him, they're mocking him for wasting his time because nothing but a little shoot comes out. And just when the farmer is ready to give up, in the fifth year, the Chinese bamboo plant shoots up some 80 feet in the air. Whether it is in our business, in our relationship with our children, or in our investments, everything meaningful in life takes time. And in the East, you have the bamboo plant as a cultural icon, as a reminder of patience and prudence. And that is probably the reason why you have much higher savings rates than we have in the West. And why Americans owe you the trillions of dollars and not the other way around. In the West, patience is comes much less natural to us. And we look to you for leadership and inspiration on that front. So whether you are our partner, whether you are our friend, whether you are our master, I look forward to taking the time to developing a closer relationship with you, and I thank you very much for inviting me. Yes, sir.